You know those times when you just feel the market is about to make a massive move, but you really don't know which way it's going to go? That's often the case when an important announcement is imminent. It's usually very likely that a big move is coming, but you can't reliably predict which way it's going to go. So most of the time, traders will either gamble, which definitely isn't a way to gain a sustainable edge in the market, or they'll just sit on the sidelines because they don't want to gamble and end up watching the market make a huge move without them on board. And if you've experienced this, then you know it's not fun. But what if there was an ultra simple way to catch these potentially massive moves, even if you have no clue which way the market will go? Well, in this video, I'm going to teach you how to do exactly that and show you a specific trade example where following this super easy strategy created 157% overnight gain. So stick around to learn this simple way to catch huge moves that you'd otherwise miss. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so this year, everyone in the market has gotten really jumpy around literally any news involving inflation and the Fed's attempts to rein it in by massively jacking up interest rates, which of course creates the potential for the world economy to move into a recession. And so when Jerome Powell, the Fed's chairman, speaks, the entire financial world is listening and dissecting his every word. And so it's pretty easy to assume that a big move is coming whenever he does speak these days. The problem is there's not really a way of knowing what he's going to say and how the market will react to it. But what if there was a way of placing a trade that has the potential of making money if a big move takes place in either direction? Well, that's exactly what we're going to be teaching you in this video. But before we get into how we construct that options trade that gives you the potential to make money on a big move in either direction, I want to let you know that if you would like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so in order to explain how this strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above the call strike price. A put option is exactly the opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call, that would expire worthless as the index didn't close above 40.75, so the call seller just gets to pocket the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, with that said, let's head back to the afternoon of August 25th, right before the market closed on the day before Fed Chairman Powell was set to speak at the Jackson Hole, Wyoming 2022 Economic Policy Symposium event that's held each year in August. And as you can see, the market is trading above 41.90. So let's say that on that day, the trader goes ahead and buys one call at the 41.90 strike, expiring the next day, the day of the announcement, and he also simultaneously buys one put at the same 41.90 strike price. Well, if he executes that trade, he has entered into what options traders refer to as a long straddle. And because at that time of day, the closest strike price to where the index is trading is the 41.90 strike, this trade is technically referred to as an at-the-money straddle, which in this case is expiring the next day. Now, let's first analyze the initial cash flow of this particular trade. And so first off, the 41.90 call was trading for $26.95. But remember, you receive $100 per point above 41.90 if the market closes above that price. So you multiply that by 100, resulting in a total cost of $26.95 for the call. And with that same logic, you pay $24.50 for the long put you bought at the same strike price. And so if you think about it, the only way you could lose the entire 51.45 that you put into the trade is if the market literally closes exactly at 41.90 the next day. Why? Well, if that were to happen, then both the call and the put would have no value the next day at the close. And that's because if the market neither closes above or below 41.90, in other words, at 41.90, then that means there is no payoff for either option, because the call only pays off above 41.90 and the put only pays off below 41.90. And so the position would expire worthless and you'd lose your entire investment. But that's not really very likely at all, is it, on a day that the Fed chairman is going to be making a major speech in the middle of the worst inflation in 40 years, right? And so it's a pretty good bet that the no price move scenario is off the table. And so let's move to the next day to see exactly what did happen. And as you can see, the market wasn't exactly thrilled with what Chairman Powell had to say, because he came off very hawkishly and aggressively in the tone of his speech, essentially warning the world that the economy is going to experience some pain before this is all over as a result of the aggressive monetary policy that the Fed will be maintaining until inflation is tamed. And so the reaction was pretty negative, as you can see, with the SPX selling off sharply and closing at 40.5766. And so because these options expire on this day, you'll be able to actually arrive at a final value for the trade, assuming you didn't close the trade earlier. And so here's what would happen. And that is that the 41.90 call would, of course, expire with no value, because obviously that one only pays off above 41.90 and the market closed 132 points below 41.90. So that goes out worthless. But the 41.90 put, well, that one skyrocketed in value because it pays off $100 per point for every point below 41.90, which, as you can see from the calculation, comes to $13,234, which means that you paid for two options and paid a combined $51.45 for those. And while one of them expired with literally no value, the other one skyrocketed in value, covering both the cost of both options and way more than that in this case. And in fact, if you think about it, there are actually two break-evens for this trade. For example, suppose that the market had instead rallied off of Chairman Powell's remarks instead of the big sell-off. Well, in that case, then, once the market got to 42, 41, 45 on the upside, then you would have at least broken even on the trade. Why? Well, think about it. At 42, 41, 45, the 41.90 put, of course, expires worthless. But as you can see from the calculation, the 41.90 call is worth $5,145, the exact cost of both options put together. And so at any price above 42, 41, 45, the trade will be profitable. And conversely, on the downside, as happened in this trade, once you got below 41.3855 and we got way below that, well, of course, as it did in this case, the call expires worthless. But at 41.3855, the cost of the straddle is fully covered. And so any movement below that is profit. And so what I'd like you to take away from today's video is that there is an options trade that's designed specifically for that kind of situation where you know that a big move in the market is likely, but you have literally no idea as to what direction it will move the market. I mean, after all, if Chairman Powell had spoken dovishly and the market reacted positively to his comments, the market could well have risen 3.3% after having sold off so heavily during much of this calendar year. But in fact, the market sold off heavily by enough to blow way past the break-even point on the trade into an incredible ultimate profit of 150% of that original cost. So you don't have to know the direction of the big move. You just have to know that a big move is coming, and assuming the move is at least to the break-even price on either side, you're going to make money on the trade. Professional options traders understand these strategies and much more because they're trained to understand that for essentially any market situation, there is an option strategy that's built to respond very favorably to that condition. Even if the condition is that you don't know what's going to happen and you aren't even going to try to guess. You just know a big move is bound to take place and you want to profit from it. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click the link to sign up now before you miss it.